Hi, everyone, and welcome back to another show. My name is Tyler, and I'm here with Matt, the founder of ORATS. ORATS is an options analytics platform built on top of over 15 years of historical options data. Our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Tradier brokerage account. Today on the show, we're going to talk about trading with ORATS estimated stock and options prices. We'll review the calculations and methodologies behind our derived prices, and then show you some of the practical applications of the data. Matt, would you like to share your screen and get us started?
Yeah, sure. So we have a document out that describes our live derived data. And basically what we're talking about is who it's good for and what it does. I mean, it's not a substitute for the actual prices. So it's used by app developers that might not need to make that huge investment in the Oprah feed and in the exchange actual stock feed that can run into the multiple thousands of dollars, even tens of thousands of dollars, if you could believe it, a month. So ORATS has developed, using options market data, derived stock prices, because every options market you can derive out using put call parity a stock price. And then we also do a summary of the theoretical value. So so what the exchanges charge for is the actual stock price, and then the OPRA, or Option Pricing Reporting Authority, charges for bid-ask prices, volumes, trade history, etc. But many people could just use the theoretical values that we get very close, and I'll show you some pictures of that, and also the put call parity that we get decently close to the stock prices, Tyler.
Okay, so yeah, thanks, Matt. That was a lot. So let's say I'm a platform that wants live option and stock price data for my platform. What are the prior to this ORATS offering, what would I have had to do to obtain all this live data?
Well, you could probably answer that question better because you're dealing with the exchanges, but you'd have to get a provider to get a feed, and then you need to pay that provider, and then you need to then have arrangements and agreements with both either the SIBO, NASDAQ, or some variation of that for stock prices, underlying price. That's usually, I don't know, $600 to $2,000 a month. And then you need to get an agreement with Oprah. And depending if you're redistributing and what you're redistributing, that goes from, again, $600 maybe for delay data to a few $1,000s for live data. Is that about right, Tyler? Like I said, you know more than I do.
No, and yeah, it's a lot. And what we've discovered is that a lot of people, don't even know about all this, all these fees and all the different things you have to do to be fully compliant. So, I think, in this process of working with a bunch of clients, we've created this solution, right? For clients who, want not a perfect live feed, but something that is just good enough. And, it's a solution that is more cost effective because you don't have to pay all these exchange fees and sign all these documents. Is that right?
That's true, and it's not like we're trying to get around the exchanges. This is, I think, getting more people involved, and then eventually they graduate, because a lot of people can't afford to do that right off the bat. And so what they'll do is they'll say, well, I really want to do this, option platform, but I can't afford it. And so maybe they'll just go to crypto if they didn't have this now, right? So, but now we could say, hey, listen, you could get a lot of the way there using these derived feeds, and then as you progress and get more clients that are demanding, it's not a replacement. You need to see the bid ask of the options and get the volume and get all that information We do have open interest, since that is just a overnight historical feed, but the volumes and the trades and all that, that's a part of the live data feed. That's
Yeah,
yeah.
I like the term graduate, because what I've seen with a lot of our clients is that we'll get startups or platforms that don't yet have the capital or infrastructure to pay thousands and thousands of dollars a month for all the live data from the exchanges and from Oprah. And so they'll come to us for it probably a quarter of the cost, or maybe even less, to get kind of a prove the product market fit for their product. And then once they get up to several hundred users, and say, all right, now we have the cash flow to support bid and ask price, and then they graduate to the next level. So I like that term, graduate. And to clarify, Oprah data, if you're a platform wondering, well, do I need live Oprah data or not, it's anything with bid, ask, price, size, and volume. So if you're just needing Greeks and implied volatilities, that's not considered Oprah data. And again, we have all this in the derived API.
Yeah, it's a good point. And I should also mention that if you're going to do anything involved with the SPX or those types of instruments, it's even more money that you need to consider. So, here's the SPX, and they charge for getting the spot price here. So we derive this spot price from options data, and that's a large savings to people. And here's that smooth market value. So so the market's right now for the 5540s, which is right at the money. It's the bid ask is 2210 at 2230. Our smoothing number is 2217, so it's within the market value here. And you can see all the smoothing values here and all the bid asks here. So you can see that's relatively close. Trying to see if there's anything outside the market. Sometimes when it gets really tight, and that might actually be a good thing to know. Oh, here's one. So 297. So this 295 might be an offer. So that might be good to know. So that's the theoretical values. And then the process of doing that is we draw this. P are the purple or puts, and the cyan are the call implied volatilities, and we draw this orange line through them. You can see that orange line fits pretty well. And this is a very difficult thing to do because you're trying to solve to get the calls and puts to line up. You're cleaning the data, then you're drawing this curve that's very difficult, and that's what creates the theoretical values. And so that's using those theoretical values then, and this curve, we could then get constant maturity or at the money volatilities and do a lot of things with that. So, we do, ORATS is kind of uniquely situated in order to bring this derived feed to people, because we have a good theoretical value for each option. And then we're also able to solve for the, in this case, the SPX implied futures. And I think we should take a second just to talk about how the SPX options are priced, Tyler.
Yeah, let's pause right there. I still want to go over the what you said about the call and put implied volatilities, and just dive a little deeper into why those are the same. Because we get a lot of questions, like people asking, why should calls and puts have the same implied volatility, right? And why is that? Because that's a big assumption that we make in this model that we use.
Yeah, so puts and calls should have the same premium. They're using put call parity, and there's an arbitrage if they don't match. Now, what makes them different often, and people kind of, I think, incorrectly think that, the call and put implied volatilities are different. It's only different if you're making a mistake on the dividend assumption or the interest rate assumption or the stock price assumption. Those are all throw off the implied volatility. So you really want to work hard to get the implied volatilities to match, and then you always want to isolate. Like, so you want to isolate what's going on. Is it the dividends? Is it the interest rate? Is it, like, it could be a hard to borrow stock? That'll totally throw things off. And you'll come in and look at most platforms, and you'll see the implied volatility for the puts are much higher than the calls, for example. But that's just what you want to do then is kind of isolate or extract out what the borrow rate is, because if people are trying to short the stock and they're trying to go out and find stock and they're paying more and more for it, that's called a high borrow rate, and that gets priced into the options. And so that is essentially becomes kind of an interest rate dividend type of thing. So hopefully that answers some of those questions that we get on the why you really want to line up the call and put implied volatility. They should always match.
Yeah, that's a good explanation. We definitely get a lot of questions from people saying like, oh, they're the same, there must be something wrong. But implied volatility is a measurement that you derive from the market. So it's I think this being an assumption that we have in the calculation is an important step.
Yeah, I mean, it's not really an assumption in the calculation. It's a overall assumption of the philosophy of options. I mean, again, there's an amount of premium in the calls. There's an amount of premium in the stocks, and then there's in the puts. So there's an intrinsic value if one's slightly in the money or the other is slightly in the money. But again, that premium should always match, and then you have like I said, kind of an interest rate component and a stock component to that. And the Greeks are based on the premium, so you need to, like, theta is totally premium dependent, so you need to really isolate that. You can't have different theta, well, unless there's a huge dividend, but that in an early exercise in American options. But for most people, you want to line up the theta for the calls and puts. You want to line up in the gamma is the same, vega is the same. Essentially, the delta is just a mirror image of each other, and that's how that should be the first step that you take to understanding the Greeks, understanding the theoretical values, understanding implied volatilities of all the calls and puts, is to line them up. So that's what we do.
Yeah, thank you, Matt. Yeah, we're not just reflecting the market price and you backing into a implied volatility. We're recalculating the whole surface, right? And
yeah, and it's actually quite lazy to do it that way, and it's very difficult to get this kind of residual yield that we come up with, that traders could either apply that to a hard to borrow or a dividend problem. And as a matter of fact, we even slope it. So what that means is for lower strikes, often the implied interest rate is different than the higher strikes. So we do a lot of calisthenics to get the residual yield right, including changing it for each, sloping it, and we present that formula. So, like, here's our that's not it. Here's our API. Let's go here. Where are we? Oh, I have an automatically running thing, but here's SPX. So there's a residual yield, and there's also this kind of residual yield slope that we can put in there. It's a little bit hard to read, but we slope each month, and so we say what the residual yield is on each month. And you can see here, I don't know if it's time to jump forward to the implied futures rate, but for indexes, we actually have a different stock price for each expiration. So could we talk about that now, Tyler?
Yeah. So what we're talking about is the SPX versus something like the SPY. So the SPX is an index, and the indexes are priced based on futures data.
Right.
Right.
Like, so the SPY would have like a consistent stock price throughout all of the expirations here, but that's not the way it works for, futures options, or in this case, the SPX, which is kind of trades like a futures options, which means that each expiration has its own kind of underlying stock price. They're all related, and you could, again, there are some arbitrage opportunities in there as well, but the spot price is kind of the price right when they say spot. It's like right now, if you weighted average all the underlyings, netted out all the dividends, did all these things, you would have a spot price. And then that spot price doesn't trade. No one will trade with you. You have to actually go out and buy like a basket, it's called, of the underlying stocks in order to create that basket. And then what happens in the SPX is that in order to hold that basket, you're going to have dividends, you're going to have interest, you're going to have all the stuff. So that changes, the actual price of that changes depending on how long you're going to hold it. Now, there's a lot of zero DTEs, and you can tell kind of like our stock price is pretty close for the front months, but then it starts adding and adding and adding because of interest rates and dividend assumptions and all the cost of holding that kind of theoretical basket of stocks. But what the market does is it tries to figure that out and then prices each expiration off of that, kind of what we call the implied futures price. And you could go into like the CME, the Chicago Merc Exchange website, and you could see that, there's, there's witching expirations. That's when the futures expire. So it would be like, June, a September, a January expiration. Is it January? December expiration for those futures rates. So you can compare what we've implied to that futures rate. And so it's, generally pretty close, because what we're doing is we're using option markets in order to figure out what the implied stock price is. And the actual future should be pretty close to that, or like I said, there's an arbitrage. So I know this is a little bit of advanced, but what it means to like users of our derived API is this is how we find the spot price, by really looking at the 0 DTE, 1 DTE, 2 DTE, or expirations, and coming up with what we think the implied spot price would be.
Yeah, it's a lot of information. The indexes are very hard to calculate and just hard to understand how to calculate. But yeah, I mean, as a platform, if you're using this derived price, you just have to pay us. But if you're using the live price from the exchange, it's thousands of dollars a month. So from my experience, it's a high price to pay just for a select number of symbols, right? I mean, you're really only getting the indexes, right? So it's I think this is a great offering, and a great explanation, Matt. But it's a complicated calculation for sure.
Yeah, I mean, like I said, some people will need the spot price, and some people will need the actual futures prices, and you could get those and pay more for those. But we try to offer things to people that are don't need that granularity or specificity. We offer this type of pricing in order to get people going and have a very good price, because this is what you need to do. You need to do the implied futures. You want to calculate that, and sometimes it's indicative of a stock move. So I mean, sometimes it's important to calculate the implied futures versus the actual futures people look at in order to see maybe there's some market maker inventory that's causing some changes. If they're getting a lot of deltas, they might try to make it so it's better for them to get short somehow. But anyway, it's a important calculation on its own, and it is important to to save some people some money on the exchange fees for an estimate of the spot price.
Yeah, I like to say our calculation is good for both research and trading,
Yeah.
because we have a lot of quants and people coming in and looking at our data, using it for research purposes, for a fraction of the cost. And then we also have traders coming in and using it, like you said, Matt. It bakes in a lot of these arbitrage assumptions and things like that. And gives you a value that in a lot of senses is probably more true than the mid price, to what the true price actually is. So a lot of people use it for trading. We use it in the dashboard all the time. You've seen us on previous episodes looking at the SMV, and that's the options derived price, and same thing for the stock derived price.
Right, and one important thing here is to get the again, you'll see some platforms still aren't doing this, and they'll have very erratic monthly volatilities where the puts are much different from the calls. Sometimes it balances out by average, but it's not a very good way to look at things. So you really want to find that good implied futures rate to base all the pricing off of. Then you get much better implied volatility, and they're consistent over SPX, XSP, which is the smaller version divided by 100 of the SPX, and then even SPY. Their volatilities should be pretty close, but there's a big difference. It's probably beyond the scope here, but SPY has an American exercise that you could still exercise after the close. So you have to be very careful with trading SPY options into expiration. But this is one of the reasons why the SPX is being used so much now, is that it expires into cash, and that's why there's a lot of popularity. But people are finding out how expensive it is just to get pricing on it, because it's basically a monopoly that SIBO has. That that you and it's difficult to use all this data and to do all the calculations. So that's one of the benefits of the derived feed, and trading with it, as we're titling this talk about, Tyler.
Yeah, and if you want to know more about the index, we did do a video, Matt, on XSP versus SPX versus SPY, about 2 months ago. So that's something you guys can check out if you're interested.
Yeah, definitely. That does dive a lot more deeply. For this talk, we want to talk mostly about the derived, how we calculate the information. What are the strengths and weaknesses of using this type of data, and how what types of platforms it's appropriate for. So we're talking for scanners, it's really good. And for some risk management, it's very good. Now, when you want to know the bid and ask, you're going to need to get Oprah data. When you want to know a very good spot price, you're going to want to talk to the exchanges about getting that. This is kind of a surrogate that you could get going on. And like I said, sometimes some people can use it all the way through. So we use the exchange for bid ask prices, but we use our derived SPX price. Otherwise, the cost for our subscriber would just be astronomical. We couldn't, it wouldn't make economic sense to do it. So that's how we do it with our dashboard product, Tyler.
Great, Matt. Thank you for the explanation. Yeah, I think it's a great offering. We have it available in our APIs for professional and enterprise clients. So if you want to redistribute the data, or if you want to use it in any non-display form, we have an option for you. Is there anything else, Matt? I mean, I think this PDF covers it nicely. I think you went over a lot of the use cases, how we calculate it, and why we do it. Is there anything else?
Yeah, no, I just think that it's especially for a platform, for retail people, the exchanges are pretty kind to them, right? You could get this kind of data. Who this is really makes a huge difference for difference for are people that are making a platform or part of a trading group that is just getting going. Would you agree to that? Like I said, you do a lot of that,
Yeah, I mean,
our exchange work.
yeah, we work with lots of enterprise clients, and I like the term you used earlier, graduating.
Yeah.
I think starting with us for a fraction of the cost, getting a derived calculation is a great starting point for platforms looking to redistribute data or use the data in a non-display fashion for calculations, like Greeks and implied volatilities, research and trading. And then once you really get your business going, graduating to the next level, and we'll help you develop relationships with Oprah and the exchanges. We've worked with them. We have a very close relationship with them, and we'll help you get going on, the cost and what forms you need to fill out and what stuff you need to send to those guys. So we'll help you through the whole process.
Yeah, there's a whole cadre of people that have no idea about this. They just want to come in and they're good programmers, right? And they're like, they're like, the option industry wants people coming in. We should get these people coming in because, what happens is they find out all the things that they have to do and they just quit. They'll go to crypto, or they'll go to some other place that, that they could use their programming skills without having to pay all these costs. But this keeps them kind of in the option industry, and they could really do a lot and make some really neat programs and use AI or do whatever they do, but not get killed by, like I said, the exchanges. So this is, I think, really good for the industry and really good for those types of programmers that want to get started and come into a really great field of the option market. Is just amazing right now. Like, so I've been involved in it. I started trading in the 80s and I was a market maker in the 90s, and I mean there's the quality of the data and the amount of trading and the liquidity is so much better now that there's still a lot of opportunity. So hopefully this type of feed will get people to come in, stay, and build a platform or an organization that could really grow in the option industry.
Yeah, I totally agree. So if you're a platform or anyone else watching this who wants access to our derived APIs, you can find them on our website, and you can also email us at support@orats.com if you're interested or have any questions about what it takes to get going on one of these derived APIs. Just like Matt's showing there, just click the professional or enterprise license, and then you'll see a breakdown of all the things there. There's a lot of information there, but I think we explain it pretty well. So, if you guys have any comments, please feel free to comment on the video or email us if you have any questions. We're happy to answer any questions about any of the tools or APIs or ORATS data and calculations on the show. It is a live show, so we'll try to get to any questions you guys ask during the show as well. Thanks, Matt. Unless you have anything else, we'll see you guys again next week.
Yeah, nice job, Tyler. No, this is where you've really helped us out. So dealing with the exchanges, so I know we could help out a lot of people coming in. So thanks a lot.
Yeah, thanks, Matt.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.